Hi, I'm Matt McAleer, President and Director of Private Wealth, joined by John Mousseau, affectionately known as the Moose, Chief Investment Officer here at Cumberland Advisors in Sarasota, Florida. Today, we will be discussing our thoughts on the third quarter of 25, ripping by, and how action in both the equity and fixed income markets affected Cumberland strategies over this period. What I wanted to start with, John, was just a broad overview to bring everybody up to the same level. Q3 performance across U.S. equities, international equities, fixed income, commodities, currencies, and cash. Within those asset classes, what worked, what didn't work, and where was the dispersion between them? As you've come to understand over the last really 3 years, within equities, it was still a large cap growth market. Very solid in the Qs, very solid in the S&P. But the surprise of Q3, if you want to label it a surprise, Moose, was small cap.
Right, about time.
The Russell 2000 up 12%. You notice it's in green, folks. So that highlights what is the best performing sub-slice of an asset class. And it was small cap. I can't remember the last time I said that. You know what's funny and what jumps out at me, Moose, is when I look at small cap almost up 13% for Q3, and the fact that for the year they're only up 10%. Math tells you they came into Q3 down 4% on the year.
Unbelievable.
The performance has been horrific. We are underweight small caps, so we didn't get that full blast of the return in Q3, but it was nice to pick something up. The only other thing on this broad chart I'll mention, and John can get into fixed income in a moment or two, on international, emerging markets really got a bid.
That was a long time coming as well.
Yeah, developed markets had been outperforming. China really started to rally in Q3. We do have some exposure within our global portfolios, but that's serious dispersion when you see 10, almost 11% return versus less than 5 in developed. But year to date, they're not far apart. Almost 29% return for EM, 25 for developed, and John, similar to small cap. It's been a long time since we've talked about returns like that in international.
There's a lot of sectors that spent a long time in the wilderness.
Well said. Well, let's talk about how that affected our strategies at Cumberland. Like normal, we start with our broad strategies. Then we're going to go over to fixed income, and then we'll finish up with our thematic strategies. So broadly speaking, in U.S. core, where our strength was, as you would guess, in large cap growth, we own that Vanguard growth ETF. It's our largest holding, very strong. Small cap showed some punch. Where were we lagging? What traded heavy, as I like to say? Equal weight S&P 500. Again, it's a large market capped weighting. What is working consistently? That equal weight, even though we reduced it and added more to the S&P, we still do in a diversified portfolio own some. That didn't do us any favors. I mentioned our largest trade in the quarter was paring back on equal weight, adding those proceeds to cap weight within the S&P 500. How about global equity? I mentioned international, very strong. Pleasure to see, to tell you the truth, in a diversified portfolio. So that international, even though for Q3, the performance wasn't as strong as Q1 and Q2, it was impressive that it held in there and actually put on gains. We've seen quarters and brief periods the last decade when international did well, but then it would dive right back in its hole.
Boom.
So it was very nice to see. What did we do in there? We added a little bit to emerging markets as the quarter went on, and we were rewarded from it. When we're talking about our global equity having a very, very solid year versus the benchmark as well. And then finally, active passive. I mentioned this as one of our core strategies. It is a balanced strategy, 60% equity, 40% fixed income. On the 60% equity side, 2/3 S&P 500, 1/3 mid-cap 400. So although mid-caps have performed a little better, still lagging the S&P.
Yeah, not winning the race versus the large cap.
Yeah, where we make up for some of that drag on the mid-caps is what we call trading alpha, and that is the rebalancing aspect on this specific strategy is based on market movements. So we're trying to sell dear and buy fear. And if that's a comment you've heard me say before, I apologize for being boring, but it is a meme we use within the strategy. Moose, what do you have on fixed income?
Matt, a good market in both taxable as well as tax-free yields this quarter.
I like to hear that.
Yeah, no, it's good, and we were helped because we're a little longer than benchmark in both strategies, and yields came down. Let's talk about the Treasury market. We have one graph showing you here the 10-year Treasury bond since the end of the second quarter to now. Start of the end of the second quarter, around a 423, rose at the beginning of the second quarter, and the struggle this quarter up to now. And those of you who are of a certain age remember the old toy, Rock'em Sock'em Robots. These have been the robots that have been fighting. It's been the fear of inflation versus the fear of a slowdown. And in the beginning of the quarter, the fear of inflation was winning. Inflation wasn't out of control, but it was blipping up a touch, partly because of tariffs, and not wildly, but the year-over-year numbers had crept up from about 2.3 to about 2.7. And so if you look in July, you can see that 10-year bond yield not hit 4.5, but get pretty darn close to it. And then things started to turn around. So what happened as you turn around? Slowing signs. This is the other robot who ended up winning the fight for the quarter. Slowdown numbers in things like housing, slowdown numbers when you look at higher credit card delinquencies, slowdown numbers when you look at consumer confidence, and it went on. So it's not just one thing. And of course, we got all the way to September, and the Fed did lower rates a quarter of a point, and a lot of speculation, and you almost touched 4%. As you sit here, you're at a 409 in the 10-year bond. And that's actually come down in a few days. And the last probably driver of a slowdown thought is the government shutdown.
Right.
When the government shuts down, and we've looked at this over different periods, what is it really? It's uncertainty. Mm-hmm. And when people hear uncertainty, what do? They run to the safety of Treasury bonds. So when you look at the quarter, the 10-year bond went from a 423 to a 415. It's a 409 now. Pretty good when you consider how elevated it was early in July. On the other hand, tax-free bonds really were getting clocked in July. Why? Well, you had a ton of supply at the end of July. It happened because you had lots of issuers postponed their issuance back in the spring. In March and April, when there was talk about taxing munis, didn't happen. When there was talk about Trump trying to fire Jay Powell, didn't happen. When there was fear of that tariffs would blow everything up, that didn't happen.
Right.
And when that happened in basically March and April, the volatility, and there was a lot of volatility in the Treasury market, made it impossible for dealers to hedge anything. So the muni market just kind of faded away then. In July, it had come back, but what happened? All these issuers who had postponed came. The demand wasn't there because most of that gets spent at the beginning of the month. So you had this period where muni yields on the long end almost hit 5% in a market where treasuries were a little below 5%. That represented opportunity. We spoke about it on our weekly broadcast. What happened? Non-traditional buyers like life insurance companies, foundations, charitable, people that don't need the tax exemption moved in and bought a very cheap asset. And it was really the long end of the muni market which had become a little disattached, partly because of fear of tariffs and the supply situation. When you look at what you turned in the quarter, it was remarkable. The 10-year AAA scale was down 36 basis points for the quarter. So from a 328 to a 292, it's about a 291 now. and the long end just as much, from a 454 to a 426. That's a big change. That means that the muni market went from way oversold, particularly on the long end, back to normal. And we think we're still constructive on the market, mainly because when you go into the fourth quarter, you're entering into the really big demand period at the end of the year, December 1st and January 1st. And even though you're going to have record supply this year, maybe 550 billion, the biggest bulge is behind us. So you're going to have good demand and probably a little bit more limited supply.
Good. And you know, it falls into that bracket that you've been discussing, yield bracket, almost all year, John, where that 10-year kind of on the top end, 460, 470, 475 this year, calendar year. And maybe, you know, on the bottom end of 375, 380 type of.
Yeah, that's where it was. I mean, the real cheapness in the 10-year Treasury bond yield goes all the way back to January, a week before the inauguration, touched a 480, did touch a 470 in the spring. But from a yields perspective, it's been 2 steps down, 1 step forward. So it has been ratcheting down the entire year. And if you continue on this path, you know, it should end up with a pretty good year for bonds. And that's, of course, you know, having some tortured years in there.
Right. Good. Okay, let's jump over to our thematic strategies. We'll start with U.S. equity ETF, which focuses on an allocation that is divided between broad index type exposure and sectors and industries. And where we really were helped out in Q3, John, was in our aeronautics defense holding, XAR, and obviously in technology. We own cloud computing. We own cybersecurity through 2 ETFs. We got a nice punch from biotech, which had been out in the wilderness.
Another wilderness child, yes.
Really had a wonderful late August into September. Where were we lagging? Believe it or not, financials. Financials have had a very solid year, but really treaded water the back half of Q3. We do have some capital markets exposure and some bank exposure. So not giving up on the sector. It was really, in my eyes, more of an exhale. Let's jump over to tactical trend. Very solid year for the strategy, John. Probably 500 basis points ahead of benchmark.
Yeah, excellent year.
And many of the individual issues have really worked. In Q3, a couple that were solid was LRCX, Lam Research, which is a semiconductor equipment maker, and a little name we added back in July, AppLovin, which, is funny as the name is, the stock is a serious stock and really compounded nicely for us in Q3. You have to be able to swallow some of the volatility with both of those names.
Right.
We try to position them small enough that we can get some bottom line return, but not have them affect us on a day-to-day movement of 3, 4, 5%.
Right.
So similar to earlier in the year, what else continues to work? Our industrial holdings. Very strong industrial holdings, small, mid, and strong,
right,
and large rather. What didn't work? Believe it or not, Berkshire and Microsoft. You think of a strong equity market, you would think those 2 positions were helpful. They've become more defensive in nature.
Do you think part of the Berkshire is Warren Buffett going to be taking a step back?
I think so.
Yeah.
I think that and the large cash position. They did a acquisition just a week and a half, 2 weeks ago, but they are holding a large cash position, looking to put it to work, and not thrilled with the levels that they're seeing from an expense ratio. We have to always consider that in how we allocate capital. So in a nutshell, that's what we saw in Q3. That's how it affected our strategies. We always thank you for joining us for this review. We hope you enjoyed it. We look forward to providing you with more content on the markets and Cumberland Advisors investment strategies on a quarterly basis. Feel free to reach out with any questions to John, to myself, and make sure you visit our YouTube channel. Cumberland Advisors has a YouTube channel where you can find other relevant content, such as our Week in Review series or investment strategy profiles. Thank you.